My name is Rena Newell, and I am a senior stakeholder with the Internal Revenue Service, and I'm part of the Communication and Liaison Division out of Oakland, California. As a stakeholder liaison, we interact and we engage with communities, taxpayers, individuals, tax pros, and small businesses to basically provide education, resources, and information for various members of the community on various topics. Um, so basically, I'm glad to be here with you to share some information as we approach the end of the filing season, which is April 15th. Today, we'll discuss some of the following: who must file, understanding business taxes, worker classification, that is an independent contractor versus an employee. We'll talk some about gross income. I'll share some business expenses with you, as well as how do you derive at your net income. And then I'll share some IRS resources, and then I'll address any questions that you have. Just as soon as I can turn this slide. Why does this always happen? There we are. All righty. Who must file? I think this is an important question in regards to when an individual is ready to file their tax return. If you basically are a U.S. citizen or a resident, whether it's a resident alien, non-resident alien, you must meet these factors for determination of if you must file. You must look at your gross income. You must consider your filing status as well as your age. This slide here basically is a breakdown of individuals that must file based on the gross income. And as you see here, it's two age limits. It's under 65 and those that are over 65. And it's based on your filing status. If you guys are familiar, when you file your tax returns, we have something that's called a standard deduction. Well, these amounts that you see here are based on that standard deduction. So for a single person who's under the age of 65, if your income is at least $14,600, you should file a return. If you're older than 65, if your gross income is 16,550, you should file a return. Then it goes into your married filing jointly, your married filing separately. Basically, it's any age if you're filing separately, if you make your gross income is $5 or more. And of course, if you're head of household, it's 23,850, and older than 65, it's I'm sorry, under 65 is 21,900. Over 65 is 23,850. And if you're a qualified surviving spouse, it has the breakdown as that as well. So basically, for any individuals who receive income at least of these amounts here, you should file a return. Now, there are some instances where individuals do not necessarily meet the income requirement. But you may have a job, a part-time job, or whatever the job may be, where you've had federal income tax withheld. Although you don't meet the income requirement or the gross income requirement, if in fact you had federal withholdings withheld from your pay and it was less than the standard deduction for the amount that you need to file a return, we encourage you, file that tax return, get the money that was withheld from your taxes back. So even though they have the limitations in terms of what you can file, again, if you have any monies that were taken out and withheld from your pay, your pension, or your Social Security, you can very much file a tax return. If an individual has made any estimated tax payments and the overpayment was applied to a subsequent year, by all means, we encourage you to file a return to get that credit back. And most importantly, for individuals who may be entitled to earned income credit or premium tax credit or the American Opportunity Credit, even though you may not meet the income threshold, if you qualify those credits, you do have the ability to file a return and get that credit. Also, if you are required to file a state return, although it may not be required again, you do have the opportunity to file that return to get any credits or payments that may be due to you. Now I want to kind of switch over a little bit and briefly discuss some business taxes. Now, depending on the type of business structure that one creates when they start a business, whether it's a partnership, sole proprietor, S Corp, or C Corp, or an LLC, that pretty much will dictate the type of taxes that you have to pay. But the most common ones that we all, of the general types that businesses have to pay is basically the income tax, estimated taxes, self-employment tax, employment taxes, and excise taxes. And I'll pretty much just give some background on the first four. Um, Basically, all businesses, with the exception of partnerships, they must file an annual income tax return. Partnerships basically file information returns, and their information is then put on a K-1 and transferred to their individual tax return. Now, the form, again, as I indicated, that form that is used is based on the type of business that's organized. And I encourage you all to have a look at business structures. If you go to our irs.gov, it basically breaks down the various business structures that you see on the right side of the related topics. So that can assist you in deciding what business structure you may want to consider or that you already have and what necessary forms that you may need to have as well. Now, as we all know, the federal income tax is a pay-as-you-go system. Basically, you earn the income, you pay the taxes. You must pay tax as you earn or receive the income during the year. Now, I'm an IRS employee, so I basically have my taxes withheld from my pay by my employer. So the IRS is responsible for basically taking out my Social Security, my Medicare, and my federal withholdings. Sometimes, though, individuals may come up short and they may not have had the appropriate amount withheld from their taxes. So one of the things that they can do is make estimated taxes. Okay. Estimated taxes are basically, again, paid throughout the year, and I'll talk a little bit about estimated taxes in a little bit. But basically, if an individual, let's say they're an employee, I should say, they may come up short, they do have the opportunity to make an estimated tax payment. One of the other things, taxes that a employer a business should consider is self-employment tax. Self-employment tax is a Social Security and Medicare tax. It's primarily for individuals who works for themselves. So if you're a self-employed individual, you're responsible for your paying into your Social Security and Medicare. Whereas I am an IRS employee, therefore my employer is responsible for that. Your self-employment tax, basically what you're doing is you're contributing to your coverage under the Social Security system. Social Security coverage provides you with retirement benefits, disability benefits, survivor benefits, and hospital insurance benefits. Also, for businesses that have self-employment income, if you have a net profit of $400 or more, then you are subject to self-employment tax. You'll basically file a Schedule SE and you will submit that with your Form 1040. If any of you have employees, then you would be responsible for filing employment taxes. That's basically reporting of your employees' wages, and you're paying your portion of Social Security, Medicare, and federal withholdings for your employee. So basically, you would complete a Form 940 for FUTA, for federal unemployment tax, which is an annual return, and then you would complete Forms 941s for your employees quarterly. Now, talk a little bit more about estimated taxes. As I stated, we are basically a pay-as-you-go system, meaning when you earn income, you should pay the taxes. I basically have a set in salary wages that I will receive every pay period. But as a business, it isn't always that case. You have income, and we'll get into it a little later, as well as expenses. So therefore, you as an employee, as a business, you'll do a projection of how much you need to pay. There's also a worksheet that you're able to complete for estimated tax payments to determine how much you'll need to pay. So as I indicated, as an employee, your employer pays it, but when you're self-employed, you are responsible for making estimated taxes. So individuals that need to pay estimated taxes are individuals, sole proprietors, partners, S corporations. If you believe you're going to owe any taxes of $1,000 or more, then when you file your return, then it's required that you make an estimated tax payment. If you, as I indicated, if you see wages or salaries as myself, sometimes we have things that happen in our life where we may get additional income and we didn't plan for it based on our federal withholdings that we have completed on our Form W-4. If that happens, then we also, an individual who is a wage earner, can make estimated tax payments. If you basically have no tax liability the prior year, there's no need for you to make estimated taxes. So just consider doing a withholding calculator. You can do it both for a business as well as for individual in terms of the incomes that you earn, and basically do a projections of what you should be, what your taxes are, if you're going to owe any taxes or not. Also, you can use the form 1040 ES to basically assist with figuring out your estimated taxes. Again, the form that you would use to figure out your estimated tax payment is a Form 1040 ES. Now, your estimated tax payments, they are made in 4 payments throughout the year. The first is actually April 15th of 2025. The second one is June 17th of 2025. The third one is September 16th of 2025. And the fourth one is actually made in the following year, which is January 15th of 2026. So there's time. If an individual feels that they're behind, one of the things I always told business owners, and I know sometimes you don't necessarily have the cash flow to make estimated taxes, but I encourage you, even though you may not make the sufficient amount of estimated taxes based on the income that you've earned, I would encourage you to do something. Let's say at the end of the year, you filed a return and you owed $5,000, but you were able to provide ES payments of 2,500. Basically, you basically only have to pay 2,500 versus a full 5,000. Will there be a penalty, an estimated tax penalty? There may be, but you won't have that large bill at the end of the year. So one of the things I've always stressed is if you have the ability to pay something, pay something. Having a little less to pay at the end of the year is better than paying a larger sum at the end of the year. Now, one of the things I wanted to touch bases on, because um, there's always a question about employee versus an independent contractor. Now, these slides that I'm going to show you, they're designed to provide information. They're not a specific determination for any situation. And the worker classifications are made on a case-by-case basis, depending on the facts and circumstances. Workers can be independent contractors or employees. And basically, how do you know who's who? Well, for federal tax purpose, this is an important distinction. Worker classifications affects how you pay your federal income tax, your Social Security tax, and your Medicare taxes, and how you file your return. If a worker is an employee, then the employer is responsible for withholding income tax and the employee's portion of Social Security and Medicare from the amounts that they pay. So IRS is responsible for paying my Social Security, my Medicare, and my federal withholdings. Now, if you're a business, the business is not responsible for paying payroll taxes for independent contractors. Many companies believe that they can choose whether they treat an employee as a worker or as an independent contractor. However, there are laws that determine whether the worker is an employee or an independent contractor. So the first step is to properly classify the worker. Now, as you see here, this basically is a definition of independent contractors, or I should say various titles of independent contractors. Now, the general rule of an independent contractor can also be found in Sharon Economy Tax Center web page. The general rule is that an individual is an independent contractor if the payer has the right to control or direct only the result of the work and not how the work is done and how it will be done. Okay. And I'll get into that. I'll give you some examples and you'll kind of get a clear picture of what I've just said. The earnings of a person who is working as an independent contractor, they are subject to self-employment tax. Now, what you see before you are basically factors that must be considered to determine whether an individual is an employee or an independent contractor under the common law. The relationship of the worker and the business must be examined. Now, if an employee independent contractor determination, all information that provides evidence of the degree of control and the degree of independence must be considered. Facts that provide evidence of the degree of control and independence fall into three categories. You have the behavioral control, financial control, and the type of relationship of the parties. So to decide whether the business is exercising the type of control that will classify the worker as an employee rather than an independent contractor, you have to look at the facts in these three categories of evidence. Now, behavioral control, does the business control or have the right to control what you do? Meaning, does the business have the right to control what the worker does and how the worker performs the service? Financial control are the business aspects of the workers of the work controlled by the business. Things like how are you paid, whether expenses are reimbursed, and who provides the equipment and the tools to perform the job. Next, we have the type of relationship. Are there written contracts or employee type benefits? Example, is there a pension plan? Is health insurance provided? Is vacation pay given? Will the relationship continue? And is the work performed a key aspect of the business? So now we're going to look at these factors individually. And I'll start by addressing behavioral control. Now, the facts about behavioral control show whether there is a right to direct or to control how the worker performs the specific task for which they were hired. So as an employer, the business or the business owner, you have to ask yourself, does the business have the right to direct and control how the worker does the work I hired them to do? Not just the end result, but I'm telling the worker what they need to do to achieve the end results. Can I tell the worker where and when to do the work? Can I determine what tools or equipment the worker should use or where to purchase supplies and services? Can I control whether the worker can hire assistants? Can I control what a specific individual must do in order to get the job done? Do I train the worker? Generally, if you have the right to control that will be done, what will be done, and how it will be done, then that individual is an employee. Okay. So those are some pretty good questions that you have to ask yourself. If you're telling the person when to show up, where to show up, how to show up, what tools to use, how to do the job, then you are basically behaviorally controlling that environment or that individual, and that individual would be considered an employee. Okay. So when we look at behavioral control, some of the factors we have to look at is the type of instruction given, the degree of instruction, the training provided by the business, when work is performed, where work is performed. Okay. So a lot of times, on my side of the job, I see where, people are classified inappropriately and when an owner or business is actually telling them what they need to do, how to do it, and when to do it. So just be careful of that. And here's an example that I thought was good. Um, does a beautician have to work a schedule set by the business, or can the beautician create their own schedule? Right? So if a beautician is basically told when to show up, how to show up, what services they'll provide, and things of that nature, then you know it can be considered an employee. So the next one we'll talk about is financial control. Financial control, basically, you ask yourself who directs or controls the economic aspects of the work? Or more importantly, who can direct and control the business aspects of the work? If the answer is yes, employers with employees would direct or control business aspect of the work. These includes things like how the workers paid, whether expenses are reimbursed, who provides tools or supplies. For example, an employee who has an established salary with no opportunity to make a profit or suffer a loss in connection with the services they provide. Independent contractors, however, are in business for themselves. They usually offer their services to the public and may have a significant financial investment in their business. They may also have their own tools. Independent contractors are also more likely to have out-of-pocket business expenses, and they can have profits and losses. So that distinction there, um, my employer, IRS, basically, they have a profit or they're not a profit organization, but any employers that have profits or basically reimburse, have wages, um, they facilitate what an employee is doing. That's an employer, but an independent contractor basically um, does the work themselves. They buy their own tools. They dictate when the time will begin, when the time will end. They basically have financial control, and based on their financial control, they can generate a loss and or a profit. Okay, whereas employers will not. They will, but it's not from the aspect from the employee's perspective. Um, So yeah, most of the time, an independent contractor has unreimbursed expenses. An employee will have occasionally have reimbursed expenses. Next, we're going to talk about relationship with worker. If you provide employee benefits such as health insurance, a pension plan, paid vacation, or sick days, generally this indicates that you're an employer. There's an employer-employee relationship. If the worker provides services that are a key aspect of the regular business activity, it's more likely that the worker is also an employer. Now, some factors of the party relationship include such things as written contracts, employee benefits, performing similar tasks for others, advertising. But generally speaking, a worker receiving benefits from the business like health insurance, pension, those are all indicators that it could be indicators that that is an employee. Now, determining the worker status for a business owner, basically, it's important to remember that just signing a contract which states the worker is an independent contractor, that does not automatically make the worker an independent contractor. Um, you must consider the categories of control, and no single fact determines whether the worker is an employee or an independent contractor. Deciding the worker's employment status up front is very important for you and the worker. If you misclassify a worker as an independent contractor and have no reasonable basis for doing it, you may be liable for unemployment taxes in the event the IRS challenges the classification that you've made that worker and or employee. If you're still uncertain of a worker's employment status, the IRS can help you. You basically can send in a form SS-8, which is a determination worker status for purpose of federal employment taxes and income tax withholding, and the IRS may be able to assist you and the worker for a worker determination letter. And you can find that letter on irs.gov, and you just type in the form SS-8. This is the form SS-8. As you see here, it has the firm's name, the worker's information, trademark name, and then the notice: the workers paid for these services by a firm other than one listed on this form. Enter that address and information. So it's a very simple form. And again, you can find more information about that form on irs.gov. Now, one of the other things that I wanted to discuss was gross income. Gross income, there's various forms of gross income. It's form of money, goods, property, services, and bartering. Basically, any income that you earn includes wages, tips, professional fees, self-employment income. That's all income that is reportable to the Internal Revenue Service. And I say it's reportable because if it's earned for any services you've provided, then whether you receive a W-2, a Form 1099, tip income that's not reported, that is actual income that should be reported to the Internal Revenue Service. Not only do you receive earned income, basically, for providing services, you earned it, you did something to get it, you also receive unearned income, which is also taxable, such as interest and dividends, any earnings if you have a bank account, any income that you earn off of monies held in the bank, that is a reportable income, as well as capital gains, distributions, cryptocurrency, that is income, and you can have gains and losses on those things as well. In addition to any taxable Social Security benefits, pensions, and annuities. So I thought it was important that I basically spent a little time here because not only am I tiny and who must file based on the threshold that we have, but I wanted to point out some of the forms of sources of income or monies that we receive. One of the things that I mentioned that is not on here is bartering. Bartering is basically, it's not an exchange of money, but it's an exchange of services from one individual to another. For example, I am a hairstylist. You have a business where you provide piano lessons. I will do your hair in exchange for piano lessons. Well, what's the value of that hair style that you're giving me? So if it's $175, then you both must report $175. There's no exchange of monies from a monetary standpoint, but there's an exchange of services, and those services have values. So I thought it was important that I share bartering with you as well. Now, expenses. As a business owner, you will have expenses. IRC 162 of the Internal Revenue Code basically says any expenses that are considered ordinary and necessary for you to conduct your business, they're deductible. To be deductible, a business must be both ordinary and necessary. And an ordinary expense is one that is common and accepted in your industry. A necessary one is an expense that is helpful and appropriate for your trade or business. An expense does not have to be indispensable to be considered necessary. Okay. And I encourage you all to look at IRS publication 535. Um, if you basically have an expense that is partially business and partially personal, you don't get to deduct the whole expense. You deduct the portion that relates to business. Okay. So basically, that would be up to you to basically say, okay, if I use let's use something we're all familiar with, a cell phone. We all have a cell phone. But let's say I may use the cell phone 10% or 15% of the time, then that is something that you can deduct of the cost. You can, you just have to explain to IRS how you derived at that. And you can take 15% of that total for your cell phone bill. Okay. You have to basically let us know. But if it's an ordinary and necessary expense for you to carry on your business, then that is fine. It is a deductible expense. These are just some of the expenses that I wanted to discuss also. There's always car and truck expenses for those individuals who may do Uber or the other deliveries or use the car in your business. You are able to take car and truck expenses. There's a couple of different methods that you can do for car and truck expense. You can take the standard mileage, which is a set standard mileage multiplied by the number of business miles, or you can take the actual mileage, which is based on the actual expenses, which includes car payment, registration, gas, repairs, etc., as it relates to operating that business. Now, if you have a vehicle that's 100% for business, then it's 100% of the deduction for those expenses. However, if you use that vehicle for both business and personal, then it is your responsibility to maintain a log to show us how many total miles was on that vehicle, how many were commute, and how many were business. If you establish that that vehicle is used 40% for business, then you will be entitled to 40% of those actual expenses for the vehicle. Parking fees and tolls are allowable for any method, either standard deduction or the actual expense. Depreciation, basically, if an asset has a life of more than a year, there you are entitled to depreciation. You can also yeah, we'll stick right there. Legal and professional fees, employees pay. If you have employees, those are expenses as well, in addition to insurance, rents, and interest expense. A question was basically how much should one, um, how much should I pay in taxes? That question is basically something that has to do with the business, either the success of the business. Basically, you see before me on the screen is a Schedule C. I just get a snap pick shot of it basically. But part one is going to have the income. Part two will reflect the expenses, right? Um, so when we're talking about how much should I pay in taxes, that all depends on how much you receive in gross income. We talked about income. We basically look at all the gross receipts that you received in your business. And then we have to say, okay, what else did I do in my business? Did I rent a equipment? Did I rent another asset that I have? That's what we call other income. So you have profit from the business, and you may have other little side things that you do that's related to that business. I'm speaking specifically about this business. You may have other income. So then you take your gross plus any other income you have or may not have to get um, your gross income. Now, when we look at deriving at our net, what expenses did I incur in my business that were ordinary and necessary? You basically offset that gross income by those total business expenses. Some individuals may have business use of the home. I can't think of the form right now, but I'll think of it real quick. Business use of home. If you have business use of the home, that is something else that reduces your net income, your gross income. Once you go through the gross income and you deduct your total expenses, then if you have net, excuse me, gross income, total expenses, and then if you have business use of home, those are all the things that will reduce your income. So when the question is asked, how much must I pay in taxes? That all depends on the revenue that you earn, less any ordinary and necessary expenses. That's going to give you a net profit or it's going to give you a net loss. So if you receive, as an example, $100,000 in income, you basically had expenses of 65,000. You have a net profit of $35,000. So you would have to pay taxes on that. And I'm just using your business strictly as an example. So you have to pay taxes on that. So there isn't a set amount of taxes that anyone has to pay. It's different for individuals who even are wage earners. My income may be different from someone else's. There may be other deductions that I may have that you may not have. So no one really pays the same amount of tax. It depends on the income that you have, the deductions that you have. For a business, it depends on how much income you made, less any of the expenses that you have. And then you can also look at the Schedule C, which kind of has more instructions um, that you can look at. But I want you to know that there is not a set amount of tax that anyone pays. We all pay different taxes because our income is different. Okay. And I guess that kind of concludes it. These publications, if you all can jot them down, I think 1779 for independent contractor versus employee, publication 15A, Employer Supplement Tax Guide, SS8, especially publication 334, Small Guide for Business Tax Owners. And then if you can just go to irs.gov, Small Biz, it has some great information. For individuals, I encourage everyone to basically get publication 17. It's a great resource. I utilize it all the time. If I find it helpful, I think you will as well. Any questions?
Thanks, Rena. I will go ahead and go through the questions now.